Okay, welcome everybody to our Prospera Energy August investor conference call. This will include the Q2 2026 results that were published yesterday morning, including updates on the company's operations and also the financial statements and the MD&A that were put into the SEDAR Plus for any investors that would like to check out the actual statements. We'll be discussing the Q2 update here. We'll be discussing some of the August and July updates, going through a bit of the key wells that continue to rise. For investors that have been following us on LinkedIn can have seen some of those, and for investors that aren't, also available on the website as a key wells report at the bottom of the homepage. And then we'll get into some updates on the financials that were released here and end it with an update on the financing as well there. So thanks for joining us, and we'll get started here. As always, some forward-looking statements here as a disclaimer that we will be discussing through this presentation. The first thing I want to discuss really is the revenue by quarter here. So Q2 2026, I'm proud to say, was the top revenue quarter in Prospera's history in many, many years of the company operating in the heavy oil space. Over $6 million of revenue was reported in the Q2 period. So over $2 million per month is what we averaged, supported by a stabilized production base. Some of the key wells rising from the loose land reactivation programs of 2025, and also obviously the higher pricing involved in the global geopolitical climate. So, definitely a very strong quarter for us, both in terms of revenue and operating cash flow, which Chris will talk about here shortly. And also, want to show the torque of the company to higher pricing is given the high fixed cost basis of the corporation. Every additional barrel and every additional dollar that we get above that price is effectively free cash flow, other than the impact of royalties and transportation. So very excited to run this base and then scale the strategy from here onwards with the next batch of reactivations that we will be discussing. And also pleased to share that the service rig has started now again as of this morning on our loose land field. So I'll get started with one of our top wells here, the 10-07 loose land well. We've been discussing this well for quite a few months now. Had stabilized in that 25 to 30 barrels per day range. There was a workover done due to some tubing erosion in that early March period. Got the well back online. You can see that staggered growth back up to that 25, 26 barrels per day. And now we are pleased to report a new high on this well at 37 barrels per day. So seeing very, very strong production. This well is flow lined right to our battery. So there is no incremental trucking cost for the production rise here that we see. And also with the oil cut going up. So very, very pleased here. We'll be keeping this well here at this 36, 37 barrels per day range. For the moment, we'll be monitoring the wellhead cuts. We'll be monitoring the sand cuts and also monitoring the fluid levels. The area that this 10-07 well is in does have some bottom water. So we're not in a position to go in and just maximize speed. We're going to be very, very careful with how we take this well. And as we will discuss later, the profitability on this well has been our top well yet, with the well's capital spend having been paid back 2 times already since reactivation in early July of last year. So only 13 months ago, we have already achieved 2x payout. We'll be discussing some of those numbers here a bit later on. And then our fantastic 16-07 well, this one, just to remind investors, had come on at a pretty high water cut. And then as we produced the water from the wormholes, we ended up getting higher and higher barrels, and the well ended up stabilizing in that 28 to 29 barrels per day range in early 2026. We then saw some sand influx that had come in about that late Q1 timeframe. Ended up doing some flush by activity and really unlocked this well. So we see it now back up to that 46, 47 barrels per day, making it our top reactivation. So despite this not having the top profitability yet, you can see how, because it's at a higher barrels per day number now, we'll just continue to produce a really high profitability and barrels as we continue going. And as you can see here, in early July, we had another sand influx phase that we're still working through on this well's path to even higher and higher barrels as we go. So very pleased with the Section 7 performance. Some of the wells in our current reactivation program are also in Section 7, having seen the successes of these wells thus far. And that brings us to our 10 of 8 well, the steady Eddy riser, as we say. It's now up to the 30 barrels per day mark. We have discussed this well extensively. Has very little bottom water at the bottom of this, produces at 60 to 70% oil and 5 RPM speed ups at a time. Slow oil cut rises over time. So nothing here we're doing that's absolutely groundbreaking. It's just consistent, proper production with optimizations as we see. And as you can see, this graph here represents about a 13-month period. So we do have to be patient with these wells to keep them online. You can see there's 0 days of downtime over the last 10 months on this well. And that's exactly what we want to show. We don't want to be doing service activity. We don't want to be forced to do flush buys on these wells. We just want them to produce nice, steady oil, allows for reliability on the production numbers, but also allows for reliability on the cash flow projections for the following month as we go. We do have additional wells in Section 8 as well, actually quite a few of them that are part of the current rig program of reactivations. Section 9 as well has been a big winner for us. The Luseland 3 of 9 has performed exceptionally. Very, very strong production out of this. A bit more sand content out of this well. So you are seeing certain days with some downtime. Also still working on the field itself and understanding how the pool is reacting to the different kind of speed ups and activity that we do. But still very, very happy. As you can see, we had this well running consistently throughout the last winter with the enhanced insulation package and the heat tracing lines and the heat pump package that we put on, and just continuing to monitor this well. There is some upside on this well that we haven't quite yet optimized for, still allowing that reservoir to just continue to produce at some of these higher sand cuts. As that sand cut starts to come down, we will start to optimize this well even more here into the late summer. And finally, our steady Eddy production in Section 17, the section with the highest cumulative barrels on some of the wells through our field, upwards of 8 to 9% recovery factor. And you can still see the wells performing very, very strongly. So some of these wells have been producing now for the last 40 to 50 years straight and still continue to produce that 10 to 12 barrels per day. So we get the question from investors quite a bit about what is the longevity of these wells, how long can they produce for, what is the true decline rate, and what we're seeing is the wells, once they get to that 10, 11, 12 barrels per day range, just continue to produce consistently at that. It also gives us confidence in the new reactivations that we're doing, that not only are they going to continue to rise, but there is the tank in the reservoir for us to continue producing for a multi-decade period. And all of that not just shows up in production and cash flow, but in our year-end reserves reports as we continue to grow the corporation, especially the Luseland pool from here on out. And we'll get to some actual numbers here. We have here our top 7 wells on the left side. We have the operating income from the wells as well shown, as well as with the barrels. And then we have on the right side the payout of these wells. So what we have seen here is that 7 wells from our list here have already returned over 2 times their reactivation capital. And the 10 of 7 has been a top performer with over $370,000 of operating income on a $150,000 capital job that we did. Very exciting to see this, not just because of the early quick payout during 2025, I remind investors, when oil prices were quite a bit lower, but also the second payout, because that second payout allows you to go and then finance the other reactivations that are currently part of our program. So very exciting to see this. We wanted to put this into exact numbers so that investors can see this. There is an update of this and a version that will be joining the Key Wells report as well going forward, so that there's clear transparency and clear accountability on these. It's exciting to see the capital fully recovered on our cumulative program of 1.7 million that was completed in 2025. We have, of 1.64 million that was completed in 2025. We have over 1.7 million of operating income to date. And the reason for that, despite the payout of some of these wells over 2x, is because some of the other wells are still continuing to rise over time. So they haven't hit their peak rates yet. We're still seeing really strong sand production out of those wells. So just babysitting those wells as we continue to go. And any of these wells are all continuing to rise. So this doesn't mean that we've hit peak rate and now we're going to decline our way to 0 barrels like some of the unconventional wells. These wells still continue to have increased optimization upside as we continue to go. And that leads us to the last bullet point here, which is this is what the current equity financing that we have in progress is buying. The $6.7 million program on the 42 reactivations that are part of this program, along with the additional 100 wells we have on top of this, run on the same well type, some of the same high impact well performance, and potential, and also some of the same reservoir quality, which leads to the same economics, just in a patient period. We have had a lot of learnings from these wells, which is allowing us to ramp up the wells a lot faster, which is allowing us to get to some of those peak rates a lot faster, and which is leading and guiding our optimization plan as we continue to rise here. So very excited to bring the next set of reactivations online. One of the things that I will point out is that despite there being almost no reactivation done this year so far, the loose land pool has maintained a very, very strong 38 to 42 cubic meters per day. That graph can be seen also in our key wells report. So, just more and more of the same, and we have the reservoir quality to back it up as we continue to rise here. And with that, I will pass it on to Chris for some of the financial highlights.
Thanks, Shabam. So I've got a few slides to present here, which are going to cover the Q2 2026 financial highlights, which is essentially a step change in the quarter. Strongest quarter of the cycle. We've seen revenue of almost $6.2 million, which was a reflection of 37% versus Q1 2026 increase, and a 26% increase versus Q2 2025. Operating netbacks were approximately $30 a BOE, up 170% from Q1. And this is really a testament to the torque of the heavy oil producer. When the pricing netbacks increase, we see this type of increase on netbacks. Both funds flow of 1.3 million and then operating cash flow of 1.5 million swung firmly positive in the quarter, all delivered with only 600,000 of capital expenditures through the period of time. The company realized approximately 85% of field uptime and 0 pipeline failures versus 5 in Q2 2025. That loss narrowed to just over $1 million from almost 2.5 in Q1. And this is what the operating engine does on 600,000 of capital expenditures, whereas the $12 million financing that Shabam was talking about offering deploys 10 million into the same proven inventory where fixed costs are already covered. Jump to the next slide, Shabam. And just kind of walking this chart from left to right, this is the netback expansion where price capture plus cost discipline is where we're starting to see some positive operating netback. Realized pricing stepped from about $69-70 a barrel to $91 a barrel as WCS averaged over $100 a barrel in the period. Netbacks nearly tripled sequentially to almost $30 a barrel. And this wasn't price driven alone, and it's important to emphasize that because operating expenses also fell quarter over quarter. There were a reduction in operating fees, and we also seen lower field maintenance driven from the spending in previous quarters. Also keep in mind that Prospera spent $2.5 million in 2025 on plant and field maintenance that was required just to improve the integrity of the infrastructure and the processing equipment. And so we're starting to really see the benefits of that carry forward into the operating results now. And so what we're looking at is approximately WTI of $75 for the rest of 2026. So if those prices hold, netbacks should also hold above the year-to-date 2025 levels. And of course, caveat that prices are extremely volatile and hard news driven, and seeing a lot of volatility even in the market today. Next slide, Shabam. This is the netback trajectory. So the reactivation engine delivering, in a sense. This is the trend chart. We talked about Q2 delivered $2 million of netback, the strongest quarter we've seen in 2 years on almost 750 BOE a day. Netback troughs a little bit in Q1 2026, with breakup, weaker WCS, the reactivation program has lifted each successive recovery. And then, we start to look at it as we go through area by area. Cuthbert remains the steady cash engine at about $31 a BOE, while Luseland is the story on a netback per BOE, which we've seen quadrupling from about $9 to $36 quarter over quarter. And it's actually now the margin leader, which is exactly the asset the financing is aimed at. Harts Hill recovered 5 times per BOE. White tundra areas are showing accretive value. And then, bridging back to the raise, 6.7 million of the 10 million targets, upwards of 70 Luseland wells, and that capital is pointed directly at the current margin leader. So I got one more slide to talk about here, Shabam, which really integrates the Q2 results into the $12 million raise and finishes the balance sheet reset. So this slide connects the quarter to the offering, framing it really as 3 columns. So first, that being the structure, $12 million financing at 4 cents per unit, with full warrant coverage at 6 cents, and 10 million of that 12 million going into existing wellbores, no new drilling. And what it solves are the 3 problems from the story slide. The debt and GOR, the subordinated pieces, are being cleaned up within 24 months. We're seeing through the financing over 2.5, 3 years that AP is being taken down 70% to a manageable 5 million, and working through a senior facility extension as well. And those items are providing the concept or the proof. We didn't wait for the race to start. $1.8 million has already been of accounts payable. Arrears has already been converted on a year-to-date basis. So we've been working with about 100 creditors, seeing deficits improving, with the kind of the close being the takeaway here, that Q2's positive cash flow on the 600,000 of capex is the unit economics proof that the raise simply scales it. And of course, caution production targets paled, and these are all forward-looking statements. But this is where we see the fact that the strategy is proven, and now we're looking to effectively scale it further, and start to realize significant momentum for the company, where it's already covered a lot of these fixed costs. A lot of the incremental production is coming online at an incremental basis, with operating costs much lower. Shabam, maybe I'll pass it back to you just for a couple closing thoughts on what we're doing next.
Yeah, thank you, Chris. And I think the main point we're making here is that the baseline of the corporation has been proven. We are going into a very different commodity price environment going forward, given the global geopolitical climate. And the company now, with the Q2 2026 results, has shown demonstrable profitability during that time frame. We still are looking forward to deploy the $12 million into the ground in order to really push the company forward, dilute down the cost of the operating cost by bringing on additional wells into a large fixed cost opportunity base with very, very high impact wells that are still currently just sitting there waiting to be brought online and providing some of the kinds of project economics that we've discussed here in this presentation. So just a investment opportunity recap. We are currently raising the $12 million equity, of which $10 million is expected to go into the ground. With the service rig starting this morning, we are already using some of the company's current operating cash flow in order to push ahead as we go and secure the commitments on this equity raise. We are currently forecasting about a 4.3x return on the investment by that December 31st, 2028 timeframe, based on a 4.2x increase in production, largely due to the loose land reactivations. And so this isn't just what can we do? It's we have projects that were already completed, and in 13 months from the 2025 program having been completed, we have paid out that entire program at a time when WTI pricing was way lower than where it sits today, and way lower than where we expect it to be. The company does expect to see significant PDP reserves increase. We have completed some in-house modeling on that that is showing incredible increases, not just at the end of 2026, but actually as of today's strip pricing environment compared to the strip pricing of year-end 2025, with the accounts payable being reduced, the disciplined capital efficiency, and then the development plan funding itself through the payout of these projects, and then the second payout as we go through this entire 140 wells that we currently have in our inventory. So we do have a full long-form presentation of the financing documents, as well as a full data room as well for any investors that are looking to invest into this private placement. And happy to chat about that or do a presentation as well as we continue down this path. In the meantime, we will continue keeping the company moving forward through the production optimization initiatives at Luseland, through additional updates to investors, through the key wells reports, and through taking advantage of this higher oil price environment to generate additional cash flow as we continue to go. So with that, I will maybe open the floor up, Sean, to any questions.
Yeah, thanks, Shabam. We just have a couple here if anyone else wants to submit in the meantime. First one is looking at the payout times of your top 10 wells of the 140 wells in your inventory, how will it pay out on a half-year basis?
Yeah, so what we're seeing on these wells is a slow, steady ramp-up phase. The 2025 wells were a proof of concept. We had to go slower than we would have liked, just as a way to avoid rig jobs. We had certain kinds of pump sizes that were put into the wells that we ended up deciding were too small. We also did not have our recycle pump strategy fully figured out. So that was maybe the iteration one. We've now had iteration two, three, four, five, and this 2026 program is going to be like a iteration six of that plan, with the recycle pumps already installed upon startup of the well, with different kind of startup procedures, including some well loads to allow for that initial sand slug to be produced a lot more effectively rather than going into the cellar. We also have several high impact wells, which the company just could not do in 2025 because those wells had a lot of sand production potential. So we didn't go after those wells at that time, despite their higher impact, despite the fact that they could have been some of our top wells, because we still had to figure out the system. So now that we have a lot more information, we have a lot more robust production optimization procedures, we have a lot more robust field operations procedures. What investors will expect to see is not just higher pricing on these wells, you will see lower cost per project on the program, but also a quicker ramp-up phase. So rather than it taking 6 months for the well to hit 15, 20 barrels a day, we expect to see that within the first 30 to 60 days. And that's what drives that first payback to be a lot sooner. And once you have your first payback, now any additional dollar is starting to pay for the next reactivation. So that's what I see as a program payout here. I also should clarify that on every reactivation, you're only paying the cost of the surface equipment once. So yes, you do downhole cost on a workover or a reactivation, but on the reactivation, the additional cost comes from a one-time cost of installing a 750 barrel tank, of buying a $20,000 engine, of building your flow lines and valves, on heat tracing and insulation. So once that is in place, it will last for the next 20, 30, 40 years. And the well simply will need potential remediation on the downhole component of the well. So we've sort of figured out the economics of this work a little bit better to scale up more rapidly and leave it open to a potential service rig activity requirement. But the NPVs and the economics of that type of ramp up procedure are just a lot better. Now that we've got the base system figured out, the base recycle pump strategy figured out, and an understanding of how the reservoir is responding as it continues to produce. So leaving a certain amounts of joints of fluid on the well to keep that sand controlled, only going up 5 RPMs at a time, only running a minimum of 13 series chops pumps, not going anything lower than that, and running them at lower velocities to avoid tubing erosion. These are some of the learnings amongst many that we've had over the past 18 to 20 months now.
Next one. Thank you for the presentation. What is the progress against the 3 million raised earlier in the year, and how do we track against the plan that was presented a few months ago?
I could take that one, Sean. I mentioned earlier the 600,000 that was spent towards well reactivations and optimizations, workovers were a direct result of that funding program, and that led the company to increase its quarter-over-quarter barrels up to the 750 that it was reporting through the period of time. A large part of that financing was also related to insider participation from board and other folks that were involved in say other notes, promissory notes, or other types of conversions from debt to equity and accounts payable conversions into that program as well. And so that essentially was the full piece of the 3 million. And what that did is it either pushed out or removed a lot of the debt maturities that were upcoming that the company was facing, and so it allowed a lot more breathing room in terms of being able to operate, reducing interest costs, and being able to employ that money into certain development or optimization.
Yeah, and I think this is something that we would like to provide a more comprehensive answer to the tracking of those funds in our next version of the Key Wells report, alongside the well by well profitability, but also into the spending and the capital efficiency per project piece of the business. So investors can expect to see that coming in. And I can't see who asked this question, but please feel free to reach out to us directly here. Our emails are here as well for a more personalized sort of walk through the exact spend and sort of the achievements of that spend as we continue to rise. One of the things I will mention is with the company's key critical vendors who are going to be part of this existing rig program that started today, but also key critical vendors for us going forward. We've been able to bring account balances down on some of those vendors significantly from the high 5-figure range, 50, 60, $70,000 range, to the $10,000 range. So it's really allowed us to have this larger credit line, reduce the cost per vendor as they see more predictability in their receiving of those accounts receivable, and just building stronger relationships with them as well. So it wasn't just like we got the 3 million and we spent all 3 right away into the ground. It's been a bit of a comprehensive cleanup across the corporation, which allows for further success of this current equity financing, which was chosen to be a larger amount, allowing us to move forward with speed throughout the remaining summer months and into the winter months this year, as we continue to see success from the 2025 reactivation program.
Thanks, guys. Next question. Can you give an update where discussions are at with the Saskatchewan government?
Yeah, I can take that. Maybe Chris, if you want to add to that. So we are still continuously in conversations with the Saskatchewan government through various parties. So if your question is referring to the MER, the Saskatchewan regulatory body, we are meeting with them still every 2 to 4 weeks. We provide them updates as to what the company is doing. As investors know, we've cleaned up over 300 non-compliances that the new management team inherited. The MER has been very pleased with that progress and is just continuing to push us to just continue to show progress on the company's overall, um, you know, obligations to the government and as far as our wells go. So we are continuing to fix berms. We're continuing to fix any road washouts. Our weed spraying program this year has been the earliest it has been completed. I think investors will note that this is the earliest a quarterly or financial or annual financial results have been reported in many, many, many years. So the company continues to move forward with actually becoming a legit junior oil producer and moving forward our business plan that is working really well. On the other Saskatchewan government side, we continue to be in communications with Premier Moe, with Energy Minister Brodry, with individuals from the Crown Sector Priorities, Investment Attraction Division, and the Ministry of Trade and Export to find additional ways, not just to support Prospera and its current push forward in restarting this pizzazz of junior oil companies in Saskatchewan and Alberta, but also just in terms of other ways to sort of support companies to bring investment into Saskatchewan that can help companies like Prospera attract capital, to bring additional more marketing to the kinds of investment opportunities that are present in the basin, to highlight some of the relationships we made with landowners and with our critical vendors. So the company maintains a very, very strong profile in that. Despite our small size, when you take into the account how many barrels the Canadian basin produces, we are having conversations at the top level, including with the team of Premier Mo directly on ways to really support this industry after it's been left for dead for many, many, many years. We want to be the proof of concept of bringing capital in, diligently deploying that capital, and building a company from the grassroots in an industry that really hasn't been easy over the last 10 years. So, looking forward to report that, and investors that are again following our Prospera LinkedIn and then my personal LinkedIn can see some more updates of that as those progress and processes continues. And we'll also aim to share some of that in our news releases going forward.
Next question, please. An update on the success of the pipeline project from November 2025.
Yeah, so that pipeline project was completed in November, December of 2025. We had two additional injectors that came online as part of that, along with additional production wells that came online as part of that. It was identified that one of the injectors, that was a third injector, had a packer failure. So we had actually gone back into that well in May, using some of the funds from the February financing along with our operating cash flow in order to fix that packer and get that well running. So that well is now part of the Cuthbert flood. It is also providing injection support from the southwestern corner of the pool. And we continue to work on Cuthbert as a slow, steady, sort of reliable cash flow producer without spending too much money on workovers and other sort of work required in order to keep the field producing. So our core focus on the capital projects has now shifted into the loose land reactivations, as that's where we see the best bang for a buck, while keeping Hartselle and Cuthbert relatively steady at their current rates. So no additional pipeline projects in progress, but we were happy to get that one done, as not only did it give us more injection capacity, brought more wells online, leading to a better water flood, it also rebuilt our relationship with the landowners and the MER, who were asking us to complete that project for a long time. So, we'll continue to find projects that are infrastructure based as we go to bring reliability to the company But as far as where we see our current best bang for a buck, it is on the loose land reactivations.
What is your ratio to successful activation to non-successful?
Of the 17 wells we did in 2025 and late 2024, we're batting 16 for 17. The additional wells that we're going after, we expect a similar type of successful rate. Now, I should be clear. There are certain wells that once we reactivate them, we find that the sand production is just wild. It is producing a lot of sand, which is good for us because it propagates a wormhole. It allows for your near wellbore to clean up, creates more permeability. But the company just doesn't have the ability to go and do these types of wells where you're having to do a workover every 2 weeks to keep the well running. So certain of those wells are offline. There's 2 to 3 wells, especially in Section 33, that are currently offline that will be part of the program as we continue to have the overall profitability and production of the company go up. So we will go back to those wells. They're not failures per se from a reactivation standpoint. They just aren't the right kind of wells for us to currently go after. If that well can do upwards of 100 plus barrels per day, but it needs 6 months of workovers every 2 weeks, that is not the project that we currently see as our top project. We'd like to bring on stable 10, 12, 15 barrel per day producers with high impact potential as our current top projects, and then go back to those other projects once we've got some more information. We've got some better cash flows to back it up, and also once we've learned from the reservoir a bit more. There is still learnings we're getting from the different kinds of chemicals, the different kinds of downhole pumps and elastomers, and as we learn more and more on that through this current reactivation program, we will go back to those wells and bring them back online. And that is, probably one of the most exciting things that I have, going around in my head is when we have the ability to bring those wells online. Because I remind investors, some of the wells that the company currently holds were producing upwards of 200 barrels per day when they went offline 20 or 25 years ago. So these aren't depleted wells that just died to 0 barrels per day, and we're bringing them back online. They had monster potential. Just the companies that were running them lost interest or didn't want to run the kinds of service rig activities that these wells demanded with the technologies of that time.
Great, thank you. Looks like that should do it for Q&A. If you guys have any closing thoughts, or we can maybe leave it for there.
Yeah, no, I just want to thank investors for attending, any prospective investors as well. The recording of this will be on YouTube here very, very shortly. Both mine and Chris's email are here. And I once again share that not only through this presentation, but we have a full 70-page long form presentation regarding this financing. And along with that, we can present that deck as well as have a full data room as well for prospective investors. We do have a 7 and 7 finder's fee as well on this raise for anybody attending this presentation or watching the replay that maybe has somebody in their network as a lead for us to discuss with. So I appreciate everybody's support and patience. Very proud to report the Q2 results with over 6 million of revenue as our top yet, but there is still work to be done. So not only on the equity placement itself, but also on just keeping the company moving forward, showing continued results from the key wells that were brought online in 2025, and further cleanup of the balance sheet as we continue on building our business here in this structurally bullish oil market. Chris, any final thoughts? So I think we can end it there, Sean. Thank you everybody for attending, and yeah, feel free to message or DM if you have any further questions. Thank you.